The biggest difference between the previous and this quarter was the move in interest rate. So the 10-year rate at the end of March was around 1.75 and trended downwards since then to the level of 150 or even below 150 in mid-June. And growth stocks and technology in particular are considered long duration stocks. So meaning that these companies have higher and increasing earnings in outer years, and in the discounted cash flow models, when you discount them with a lower WACC, then they become more valuable. And secondly, the rally of some of the cyclical stocks at lower quality stocks have been very, very strong in the previous quarters. Many of them were actually even overshooting the pre-pandemic levels and anticipating the very strong growth in 2021. The best performing sectors were more defensive in nature. These are like consumer staples and healthcare and technology. This was a sector which was beaten up in Q1 and saw a revival. The absolute majority of our stocks in the sectors did contribute very nicely, and outperformance came particularly through our stock selection. In terms of regions, LATAM has worked with our fintech exposure, Canada through Shopify, Australia via Atlassian, and these were all stocks which were losers in the quarter before and saw a reversal. Biggest detractor was China. China, as we know, came out of the pandemic earlier than everybody else by almost more than a quarter. But currently, the biggest driver of GDP in China is actually the export sector, because the world is opening up, as we know, and inventories are low, and that helps China with their export sector. But the service sector in China is really lacking, and I assume it will do better in the second half. We have added cyclical exposure already in Q4 and in Q1. And currently we see still some opportunities in the energy sector and the banking sector. And banks, which we have been underweight for many years now, we have reduced the underweight a little bit in Q2 by adding some of the European banks called BNP and Intesa. And we think that Q2 results will be another beat after a strong Q1. It's not because of the top line, it's more because of the bottom line, because cost and provisioning should be lower. The question is, will inflation be transitory or will it stay elevated for many years to come? And I'm pretty sure on commodities and transport that it will normalize as supply chains will be in sync with GDP or overall growth. But the big question mark will be on wages. Will people come back to the workforce when the paychecks will run out? Will they relax the shortage in labor and therefore the worries about rising inflation, rising yields, and tapering of central banks? And the other big question will be, what happens to fiscal and monetary stimulus? So we have seen over $30 trillion in fiscal and monetary stimulus in the last 15 months. That's totally unprecedented. And this time around, opposite to the financial crisis in 08-09, the majority of the European countries and Japan beating the US in terms of stimulus, fiscal and monetary as a percentage of GDP. And I think it would be quite difficult for the central banks and politicians to withdraw the stimulus meaningfully. International markets are more cyclical because they have less tech, more financials, more commodities, and finally valuations are lower and on a very depressed earnings level. So that should actually help the international equity space. And we currently favor developed over emerging markets. Brazil is a little bit of an exception. It's a country where we have some exposure, and it's a country which has a strong vaccination history and infrastructure. And once the doses are available, it will go very quickly in Brazil. What I like as well in Brazil is it's a little bit of the Silicon Valley of Latin America, a lot of entrepreneurs, well-educated, with a large home market, and regulators encourage competition and change. And then finally, which the biggie is, of course, China is the one to watch. It was an underperformer for the first half because, as we know, reopening has happened earlier. But the government and central banks has not been accommodative as in the rest of the world. So there were more companies which have defaulted, and it's likely that China starts easing towards Q4, which would be taken positively by the markets.